Welcome to Simple Investing Secrets, your trusted destination for uncovering the finest stocks to buy and discovering cutting-edge investment strategies to build enduring wealth. In today's video, we will examine the top 12 best stocks to buy in September 2023. As an extra bonus, we'll reveal how you can acquire as many as 16 free stocks to bolster your investment portfolio. So be sure to watch to the end. Don't forget to like this video and subscribe to our channel to receive weekly updates. Let's get started. The year 2022 proved to be a disheartening one for the stock market, as various challenges caused significant declines in key indices. Despite accounting for dividends, the S&P 500 experienced a substantial drop of 19.4% over the course of those 12 months, while the tech-focused Nasdaq Composite took an even greater hit with a decline of 33.1%. Several well-known factors played a role in triggering Wall Street's sell-off, a scenario all too familiar to seasoned investors. Inflation loomed large, and concerns about a coming recession persisted despite skyrocketing interest rates. Additionally, the escalating conflict between Russia and Ukraine acted as a catalyst, further intensifying the mounting anxieties that investors simply could not overlook. Consequently, the prevailing sentiment in the market shifted towards risk aversion, leading to significant losses for many previously high-performing stocks. However, amidst the turmoil, a silver lining emerged. The market downturn presented a valuable opportunity for astute investors to seize bargains by acquiring outstanding companies at discounted prices as they navigated into the new year. With that said, let's review our list of the 12 best stocks to buy in September 2023. Number 12. Meta Platforms Incorporated, stock ticker, META. Meta Platforms, formerly Facebook, is a favorite on Wall Street. It's the fourth most commonly found stock in ETF portfolios. However, the past year has been a tough time. Although that may send most investors running for the hills, it's actually an opportunity. Meta is a growth stock by just about any definition. The company has had solid revenue growth for years, and earnings per share growth was impressive until the most recent earnings report. Moreover, the stock was known for tremendous price appreciation until the rug was pulled from the tech sector as inflation concerns set in earlier this year. The declines have created an opportunity you don't see often. A growth stock that can make value investors drool. Meta is trading with a PE ratio of around 12, while the S&P 500's PE is over 19. The stock's PB ratio is also sitting at a 5-year low. Even with these headwinds, Meta offers a unique opportunity to tap into a stock that has historically outperformed the market in a big way, but to do so at a steep discount to the current market value. Number 11. JPMorgan Chase, stock ticker, JPM. Following a sudden plunge into freefall, First Republic Bank underwent a takeover by the FDIC, subsequently being acquired by JPMorgan Chase. This single fact has attracted significant focus to the banking behemoth. As per Zacks analysis, JPMorgan Chase is recommended for purchase. However, this recommendation isn't solely based on attention-grabbing headlines. Zacks research indicates that JPMorgan Chase holds a Zacks ranking of 2 and their projections suggest that this banking stock is poised to yield returns higher than the market average in the forthcoming months. Number 10. Apple Incorporated, stock ticker, AAPL. First up is Apple, the largest publicly traded company in the world if you exclude government-backed behemoths such as oil giant Saudi Aramco. Like other tech stocks, Apple shares had a rough go of it in 2022. As recession fears and soaring interest rates spooked investors in the sector. Following a rare 26.4% pullback in 2022, Apple shares have bounced back to the tune of 38.3% in 2023, recently hitting all-time highs. The $2.8 trillion iPhone maker now trades at around 30 times earnings, reflecting the market's confidence in the company's strong competitive moat. Apple recently unveiled its newest product, a virtual reality headset dubbed the Apple Vision Pro, which will retail for $3,499. While that price tag will likely make it a niche product in the early days, investors are hoping some iteration of the technology will emerge as a new source of meaningful revenue alongside product lines like the Apple Watch and the Mac. Number 9. Dutch Brothers Incorporated, stock ticker, BROS. While massive, established companies like Apple can offer investors some stability, smaller companies have more room for expansion and can boost portfolios. Enter the rapidly expanding coffee chain Dutch Brothers, which for comparison's sake, is roughly 0.2% the size of Apple despite being worth about $4.6 billion. Revenue grew like a weed in 2022, surging 48.4%. With initial roots on the West Coast, Dutch Brothers locations are almost entirely in the West and Southwest, with 716 locations in 14 states through the end of March. The small footprint of its drive-through stores means they are relatively cheap to open, allowing for faster expansion. That shows up in the numbers. Dutch Brothers opened 133 new stores in 2022, which works out to a location growth rate of 25%. While the company's stock got off to a hot start in 2023, shares sank in early May after a quarterly earnings report that fell below analysts' expectations. Shares are more or less break-even on the year through June 6. Number 8. Citigroup Inc, stock ticker, C. Next up is Citigroup, a $90 billion multinational bank with both retail and investment banking arms. What Citigroup offers investors is twofold. First, it pays a healthy 4.3% dividend yield, which is a nice buffer for shareholders in an era of rising rates and high inflation. Importantly, that dividend is sustainable over time, with Citigroup using less than 30% of earnings to finance its payouts. Aside from its high dividend, Citigroup also looks like a value stock at current levels, trading for less than 8 times forward earnings and just 0.49 times book value. Famed investor and financial guru Warren Buffett began buying Citigroup stock in the first quarter of 2022, and Berkshire Hathaway Incorporated, tickers, BRK.A and BRK.B, now owns a roughly $2.6 billion stake in the company. Citigroup stock is up 6.6% in 2023 through June 6. Number 7. Amazon.com Incorporated, stock ticker, AMZN. Dominant internet retailer Amazon was also named one of the 10 best stocks to buy for 2023. The e-commerce giant had a miserable 2022, in which shares lost 50% of their value. The culprits included cost inflation, a tight labor market, supply chain challenges, and dwindling consumer confidence. That said, the market was far too eager to write off Amazon, whose crown jewel is Amazon Web Services, its large, fast-growing, and massively profitable cloud services arm. AWS has an annual revenue run rate of more than $85 billion. Given that cloud services rival Microsoft Corporation. Microsoft trades for about 12 times sales, putting the same multiple on AWS pegs its value at $1.02 trillion. At Amazon's roughly $1.3 trillion valuation, investors are getting the rest of the company's massive operations, which posted 2022 sales of $434 billion, for about $280 billion. Amazon has proven to be a great pick thus far in 2023, with shares up 50.4% through June 6. Number 6. Walt Disney Company, stock ticker, DIS. One of the most important things to consider when selecting stocks to buy and hold for the long term is a company's management team. And with the recent return of longtime CEO Bob Iger, Disney has that in spades. Considered one of the best CEOs this side of the millennium, Iger presided over a series of wildly successful acquisitions, including Pixar, Marvel Entertainment, and Lucasfilm, before passing the CEO role to Bob Chapek in February 2020. Disney's May earnings report saw the House of Mouse meet expectations for both earnings and revenue. A recent price hike for streaming service Disney Plus helped soften the blow of a huge loss in subscribers, largely from its India platform Hotstar. Disney's stock is up 6.1% this year through June 6. Number 5. PayPal Holdings Incorporated, stock ticker, PYPL. A time-tested financial stock, PayPal is curiously trading for less than its 2020 pandemic lows, despite earnings per share of $4.13 in 2022. Higher than any year between 2018 and 2020. Shares were absolutely hammered in 2022, shedding 62% due to a weaker macro environment and the loss of its lucrative relationship with eBay Incorporated. Shares now trade for about 13 times expected 2023 earnings, despite a 5-year average ratio of 36.5. Between 2015 and 2021, PayPal's lowest price earnings ratio was 20.3. Applying that conservative multiple to its average expected 2023 earnings of $4.95 yields a price of $100.49 per share by early 2024, implying an upside of more than 54% from its June 6 close. In addition, Amazon now accepts Venmo, which gives PayPal exposure in Amazon's sizable online marketplace. Recently announced deals with Apple Pay to accept PayPal and Venmo branded cards should expand its presence in brick-and-mortar retail. PayPal shares tumbled in May after the company reported less than stellar earnings and lowered its 2023 operating margin estimate, and the stock is down 8.7% in 2023 through June 6. Number 4. AOG Resources Incorporated, stock ticker, EOG. A return pick from last year's best stocks to buy list, AOG is a U.S. oil and gas producer coming off a successful 2022 in which shares posted a total return of 56.3%. Shares nonetheless are still priced like a value stock, trading for less than 10 times forward earnings. Growth will no doubt decelerate in 2023. The red-hot energy market is unlikely to skyrocket as it did in the inflation and war-plagued year of 2022, but investors shouldn't forget the value of an inflation hedge in their portfolios. A 3% dividend yield and an impressively low payout ratio of less than 20% give AOG some credibility with income investors as well. As inflation concerns ebbed in the early months of 2023, AOG shares lost ground. The stock has a year-to-date loss of 10.9% through June 6. Number 3. Devon Energy Corp, stock ticker, DVN. Devon Energy is an income investor's dream. The company is the highest-paying dividend stock on the S&P 500. Devon Energy is an oil and gas powerhouse with a long history of stellar performance, and after more than 80% growth over the past year, the share price growth is expected to continue. Income investing veterans may be thinking, DVN is only paying dividends because oil and gas prices are soaring. But that's not the case. The company has consistently paid strong dividends to investors for the past 29 years, even when oil and gas prices have been down. It has a strong balance sheet and impressive credit rating. Even when the oil and gas industry isn't so hot, the company has access to the money it needs to pay dividends. The Organization of Petroleum Exporting Countries, OPEC, the world's largest oil cartel, recently announced plans to boost oil production. The announcement sent DVN falling, giving up much of the gains it's seen this year already. Although the stock is up 12% year to date, it's given up more than 33% of its value in the past month. Nonetheless, if you're an income investor, chances are you're not too concerned with price appreciation. You're more interested in the quarterly dividend check. When you invest in Devon Energy, you can rest assured that meaningful dividend payments will come on schedule, just as they have for nearly 30 years. Number 2. Taiwan Semiconductor Manufacturing Company Limited, stock ticker, TSM. Taiwan Semiconductor Manufacturing, a $520 billion business and the dominant high-level foundry for advanced chips, is next on the list. In the semiconductor industry, foundries are companies that manufacture chips for other companies, and TSM enjoys a massive market share for chips 7 nanometers and under. Apple, which has started to shift its supply chain away from China, is one of TSM's biggest customers. While the company reported mild gains in revenue and net profit in the first quarter, those numbers were down 18.7% and 30% from Q4 2022, respectively. Number 1. Diageo PLC, stock ticker, DEO. Last up is Diageo, the $95 billion UK-based beverage giant. As a consumer defensive stock, Diageo should be able to hold up in a strained macro environment, as alcohol tends to be relatively recession-resistant. As with tobacco, alcohol consumers tend to have a fair degree of brand loyalty, and the company's slate of elite brands gives it enviable positioning in its space, with bar staples such as Johnnie Walker, Guinness, Tanqueray, Don Julio, Smirnoff, Baileys, Ciroc and Bulleit all under its umbrella. Despite net sales jumping 21.4% in fiscal 2022, the stock fell with the broader market last year, losing 17.4%. That's largely due to its base in the UK and a bad year for the British pound. That slump can't last forever, and shares now trade for about 19 times forward earnings, a discount to their 5-year average forward PE of 24.4. As of the first quarter, Diageo is also part of Berkshire Hathaway's portfolio, with Buffett buying up about $40 million of the company's stock in the first quarter of 2023. Shares have slipped by 4.1% through June 6. And now for our bonus offer. We'd like to thank Moomoo for sponsoring this video. And as a limited time special, Moomoo is offering up to 16 free stocks and a cash reward when you open a brokerage account through our special link. Moomoo will give you up to 16 free stocks plus a $50 cash reward, including 1 free share of Tesla or Expedia Group. So click on the link in the description to get your free stocks today. As always, it is essential to do your due diligence before committing your hard-earned cash to buying stocks or investing in the market. Remember to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thanks for watching, and best of luck with your investments.